Welcome to the Day Trading Show, everybody. We've got an amazing episode for you. We've got Steve Burns on to talk all about current market conditions, his new book, and how new and struggling traders can adapt some of the principles that the legendary traders Steve and myself and James have studied from, how you can implement those tactics into your own trading. So sit back and enjoy this incredible episode. All right, everybody, welcome back to another episode. We are very excited. We've got the legend, the man himself, Steve Burns, here for a very special episode of the Day Trading Show. So, Steve, first, thank you again for joining us, brother. It's good to have you.
Hey, good to be with you today, Austin and James.
Yeah, absolutely. I know this is our second time on a interview style, podcast style conversation, you and me, Steve, but now bringing James into the mix. This is super awesome. I'm really, again, just appreciative of everything that you do. I was just saying, I appreciate you following me on Twitter and staying up to date with me. I just love that you and I have been able to build this relationship, and it's really introduced me to some amazing people. We actually have Anthony Crudell coming on the show in a couple of weeks, and he's a guy that I met through some of the content that you've shared. So just very appreciative, brother. So let's jump in. I know everybody's here. They want to hear some information about what you've got going on right now. The new book, it's everywhere. I see everybody talking about it, The Complete Guide to Price Action Trading. And I wanted to know first, Steve, what inspired this book? Because I know you had me write the foreword for a previous book about technical analysis, but why specifically price action trading?
I think there's a lot of confusion about what exactly price action trading is, and I wanted to put a format down to explain what it is, the entry signal, the exit signal, the profit target, the trailing stop, the managing of the trade once you're in, the creating the edge in the entry, candlesticks, chart pattern. I wanted to really have a step-by-step guide, something I wish I would have had. Everything I create, something that I wish would have been more clear. I mean, I wouldn't have had to read 400 plus trading books if these things were clearly expressed without wasting 400 pages with anecdotal stories that mean nothing, and just get to the core reality of trading. So that was really probably, I think if I'd been in the works for 15 years of my thought processes around the dynamics and the process of trading the price action, specifically, not the opinions, rumors, talking heads, what you think is going to happen, the reality of what's going on in the current moment with the price action.
I love that. That's such a great answer. Do you think, it's interesting, as we talked about in our previous interview, you got a lot of initial attention when you were starting your to build a following from writing reviews to all these books, these trading books. Am I correct?
Yeah, I was at one time the 151st most helpful reviewer on all of Amazon.
That's crazy.
All categories. And all I reviewed basically were trading books and investing books and maybe some finance books early on.
It's crazy. So you had this I would say broad view of a lot of different perspectives into trading and investing. So why do you think it's taken so many reiterations of the same techniques? Because we've known in a way what winning trading looks like. So why is it so difficult? Is it that it has to be said from a certain perspective to stick with every person a little bit differently? Like, why is it so hard, do you think, to get that message through?
The biggest confusion people get into around the trading is the context. People are having arguments, and one's a swing trader, one's a day trader, one's an investor, and they're all having an argument, not even understanding that they could all be correct on their own time frame and their own process. I mean, there's buy and hold SPY traders that held SPY for 20 years or 25 years. They probably made pretty good over time. And they also had horrendous drawdowns that, worse than any trader would ever have. And the same way a prop trader, a day trader could be making nice returns every day, but a swing trader thinks it's impossible to make money day trading. It's almost like different languages they all speak and have preset belief systems, and they haven't studied the full array, like you said, all the way from value investing all the way through day trading, through all the market wizards books, and really in the trend followers and get a handle on everything and all the different perspectives that are available.
Yeah. So it's almost like the context itself is super important to understand. And it's very foggy when you first get into finance and investing and wanting to manage money, whether it's your own or other people's. I think, like you said, a lot of people don't pick a lane and stick to it, so to speak. And it's also because the words day trading and investing, or just trading, they are intermingled in the common nomenclature. People, intertwine them, even though they don't mean the same things. And I think if people get more clarity on what type of trader they want to be, they can probably align with their most successful trading results quicker. You know what I mean?
Yeah, in the context of what they are doing specifically. I mean, even see legends dismissing other entire categories of trading. One trend follower said, no day trader ever made money. While there's value, investor said that nobody ever made money in technical trading. Well, the Market Wizards books document that people become multimillionaires, even billionaires in every different form of trading. And it's an edge. It's not what the time frame is or what the specific thing is. It's the edge of the process from everything from day trading to value investing, whether your average win's bigger than your average loss and what your risk dynamics are and if you can psychologically do it and how much your screen time is. And it's just fascinating to me that people just dismiss all the other things outside of their own little genre. It's always fascinating to me.
It's very, very true. So why do you price your books so cheap? That was a question I had written down for a while. I meant to ask you, why $10? Because some of these books, I'm sure you reviewed some of them, $80, $90. Textbooks, $150. Why 10?
Yeah, I spent a lot of money, wasted a lot of money on a lot of high dollar books that for 10 pages of content, you read 300 pages of stories. But, they're small books. They're not big books. I don't waste your time. No. I think the most valuable asset is time. So it's not a big book, and I have them in paperback and on Kindle. And, it's just a quick read. It's a thorough, it's deep dive. Most people read my books multiple times. So it's not easy to get it. It's deep, but it's to the point and brief. People do like that about my book. So it's not a big book. So it's not anything like a lot of people say, there's no secret sauce in here. There's no holy grail. It's like, it's a process of trading that it took me 20 years in trading, 30 years in the markets to get to this process, and they dismiss it. They're looking for the magic fairy dust, and there's no magic fairy dust in this book. Like, no, it's just showing how to create an edge and trade price action. It's a profession like a lawyer, a doctor, or a trader. You're doing a professional endeavor. You can't say, hey, tell a surgeon, can you give me quick tips on how to make a lot of money in the medical field? Hey, this book doesn't tell you how to do brain surgery. It's just talks about it's fascinating, but they're not big books, so they aren't expensive.
And we all appreciate it. We all appreciate the low cost. James, you were about to say something. Go ahead, brother.
Yeah, I was going to ask Steve. So, we obviously also use moving averages. And I know I've read a couple of your books on, the moving averages. And you always talk about, what moving averages you're looking at specifically. Saw on one of your New Trader U PDF, the little write-ups that you do. I saw you look at the 8, 21, 50, and 200 day. What time frame are you mostly looking to enter your trades on, or watch your pairs or ticks that you're watching? What time frame?
Yeah, my primary moving averages are the 5, the 10, the 20, and the 30. Okay. The 50 is also in for some of the longer term trends I try to capture, but I'm more of a swing trader. So I do trade the daily chart, the daily candles, and I do look for capturing 3, 4, 5 day swings in one direction. Unlike a trend trader or trend follower, I'm not going to hold to a long range. It's very rare because I'll normally get stopped out if it falls below support, but it's 520 crossovers, one of my favorites. Trend Spider actually has technical indicator called the Steve Burns moving average ribbon now. It's on the Trend Spider platform.
I love that.
It does have the 5, 10, 20, 30, and 50 automatically on your charts for that.
That's awesome.
And those crossovers, the 5 to 20, the 10 to 30, the 5 to 30, and the 10 and the 50 are the best ones to back test first. They're generally ones that will have an edge on charts that tend to go up over time, especially indexes and leading growth stocks.
Yeah. And I think you'd probably agree, Steve, that whether you use a 5 or an 8, it's about back testing it, finding the consistency, finding the edge within that EMA. There is no right or wrong EMA. It's, again, the context you're trying to use it in and what are you using it for? I feel like a lot of the time people will talk, as you said already, they'll talk down to indicators. Like they're lagging, they're this, they're that. Like they have an opinion because they're coming from this one closed-minded perspective on indicators based on their experience previous. But instead of being open-minded and unbiased to what could these indicators tell me? Well, maybe they're not giving me the exact entry signal, but maybe they're helping me read a trend. And then I can add this and that to get to an entry signal because of the trend that they're showing me. So again, just lost in context. Again, people come into trading, they want that instant one thing, give me that crossover, that's my entry kind of thing. And it's just not that easy. If it was that easy, we would not even be sitting here talking about it. You'd be on Steve Burns Island, I'd be on Austin Silver Island. It would be chilling. You know what I'm saying?
Yeah, they also get obsessed with win rates. You know, the real magic is in the edge and the compounding of capital. If you can get an
Yes.
account you don't have to use for living expense, you can just compound it. That's where a
Yep.
lot of magic happens. People,
Mm.
the two things traders especially just ignore, or even get to a tax-free account like an IRA or 401k and compound it tax-free. It's another thing. Traders, we pay so much short-term taxes and short-term capital gains, and the tax we have to pay at the end of the year when we're really successful. There's so many real life dynamics that few
Yep.
people think about.
Yep, absolutely. And James, I feel like, is a really good example of that, because James has, a lot of people, when we are out there on social media, and you come across more people than us almost, Steve, and I'm sure a lot of them come to you as brand new beginners. They want those big 10R, 15R trades. They think that that's what they need. But like, again, to point to James's success, 81% win rate, he's getting 1 to 1.5 R, and he's in and out of these trades quickly. So if you look at like who is living that trader lifestyle, so to speak, James isn't catching these big 10R rips, but James is trading for a shorter amount period of time. He's compounding his wins, stacking capital, and he's making more money with less time. Because I think, and I've said this before, people get lost in this illusion of full-time trading, where they think they need to be at the desk 12 hours a day. It's like, no one got into this business to be stuck at the desk that long, right?
Yep. I love when you talk about quality of life. You're the only other person besides me that I've ever heard mention like screen time.
Yeah.
Like if most day traders I know that are successful, and even the ones you have read about, they usually trade about first open for the equities, the first hour and a half. They make their money, they go on. I day traded for a year. I really just got back. Swing trading was it for me, but that was it. When I had a good day, it was between the open and an hour and a half in, or the first breakout, and that was it. I mean, sitting through the lunch hours, and it goes nowhere. Maybe the last hour, but it's just ironic to me. Like you said, you think a job's stressful. You sit in front of a screen for 8-10 hours a day and trying to catch every little blip. It's far more stressful than a job, But
100%.
I think you nailed it too. Nailed it. Like a day trader, about 80% win rate, 1.5% profit factor. That is a good day trading system. A swing trader could be 50-50 with a 2-to-1 or a 3-to-1 reward to risk ratio. And that's about right. But like you said, it's all dependent on the system. Warren Buffett probably has some 50 times or 100 times stocks over his long career. So it's different based on every strategy, every system, and every time frame. Like you said, people want those big winners, but they get antsy when it take the small profits immediately in almost every time frame. That people hate letting winners run, and they hate cutting losers short. They want to hope they get back to even.
Yep. And that was you talked about that a lot, the disposition effect. They cut those winners too quick, and we hold the losers way too long. And I think you also have shared a lot of Peter Brandt's content, which put me on to the idea of avoiding popcorn trades. If you're up 1, even 2, 3R on a trade, you should never, ever, ever go negative on that trade. If you're a day trader, especially, there's always another day. But I think the ego comes out, and you don't want to be wrong. You knew this was going 5R. I'm not going to just settle for 3R. I'm going for it all. And that ends up costing you money. And I would totally agree with what you said too about me. I'm a perfect example. I've given back more money in the afternoons than I've made. So what's the point of sitting here and trading in the afternoons? Why? Because you like to trade? Well, that's not what really trying to grow a trading business should be aligned with. That's like a different type of itch you want to go scratch somewhere else,
Exactly. I mean, trading for a living should be a pursuit of happiness and quality of life, not obsessing. I mean, that's a path to unhappiness. Most people I knew obsessed and traded too big and worried about every tick and wanted to predict everything, and just a complete road to failure.
Miserable failure. Miserable. Yeah. You're done. You're burnt out. You got no friends. Yeah. Stressful. Like, cool. You were right about gold, bro. Good job. Like, you're the man. Like, it really matters, man. Now you got no one to enjoy it with. No one wants to be around, like, no, of course not. That's definitely not the reason we got into it, but it is something to consider. And I think this is why trading psychology is such a hot topic, because we get into trading with these big dreams and visions, and then you sometimes get lost in the sauce and you forget that this conversation. Some people are probably listening to this like, yeah, I actually don't want to be at the desk 6 hours a day. I want to figure out a way to do what Steve said and be done in an hour, be like James, done in an hour kind of thing. So I think you almost sometimes need somebody to pull you out of the sauce, you know what I mean? And like pull you back and say, what are you really in this for? So what's keeping you motivated now, Steve, during the way markets are right now as a swing trader? It's probably, an interesting time, because I know 2020, 2019, even part of 2021, it was a very strong bull market. So now how are you navigating through what you would say is I mean, first, I guess I could ask you, do you think we are technically in a bear market? Do you navigate this the same way as you did the bull market?
No, when the volatility gets really high, that does not fit really my swing trading strategy. I did take a bunch of long positions recently, but it was after the downswing happened, after it found a bottom, after it got oversold, after it bounced, after we had a bunch of candlestick reversals, after I had some 520 crossovers, and it was in the stocks you'd expect, some copper stocks, Alcoa yesterday, the indexes, tech finally. I've gotten so much into a systematic process. My little discretion I have left is in my watch list and in looking at the volatility factors and the average true range that things are trading in to set my position sizing. But I'm so automated now. If it's plunging and the volatility's high and it's swinging wildly, we had those big Dow days. It does not bother me the least bit to be in cash and be waiting for the madness to stop and to give me some tradable thing. Even commodities got so volatile. It just doesn't fit my process. I'm looking for a 3, 4, 5 day swing. I'm not trying to hold through something that's moving so wildly every single day. I have no interest in that. That's even wild for some day traders to get involved in. So
for sure.
I've become very systematic. I'm just waiting for my signals and taking them when they're happening and managing my position size. And I've gotten very, very mechanical at this stage in the game. So
are you optimistic in the US overall? Everyone it's super easy when stocks are down like this and the war right now and everything. Are you optimistic that this is a pullback and we are going to see a new all-time high soon? Or do you kind of lean, of course you don't know, none of us know, but do you kind of lean more in the pessimistic view where we might see some more lows in the near term future?
Yeah. As an equity trader, I know that I think right now the US is spending about 625 million more a day in gasoline, and that money's coming out of consumers' pockets, coming out of businesses' P&Ls as they spend on transportation. I think Target had $1 billion more than they expected. So, the macro realities. I enjoy economics, love economics on a sidebar. I still wait for my signals and I trade them, and I have them on watch list off commodities. But as an equity trader, I cannot not know that it's we're getting pummeled. It reminds me a lot of 2007 when oil was so high. And the first time I'd learned, like, man, this money coming right out of these companies' P&Ls and companies that don't have pricing power to raise their prices are going to be and have narrow margins are going to get hurt. And that's already showing up with Target and Walmart and even several grocery stores.
It's a great point.
Consumer staples aren't doing as well as they normally do because those margins aren't enough. They don't have the pricing power. And then we have, like you said, we have the supply chain breaks. Still some COVID remnants, plus the exporters of Ukraine and Russia are not going to be exporting the wheat. So, that wheat ETF has just gotten completely wild. A lot of the Fed's got to unload a $9 trillion balance sheet with mortgage-backed securities and treasuries, and then we've got the government spending crazy deficit spending, and then just having the Fed buy the treasuries and put it on their balance sheet. From an economic standpoint, it's crazy.
It's crazy when you put it like that. It's like a cake of bad economic things setting up for us, and that's kind of why I was really interested to talk to you more today about what you're doing and to be, I don't want to say prepared, because I think guys like you and me, we're always prepared. And James, we're always trying to take in knowledge and information to make ourselves prepare for tomorrow, to make good decisions tomorrow. But I was trying to get more your adaptability during different market cycles with the focus maybe on reacting to how the market is today, not getting caught up in that economic forecast. Because guys are often like you and me, where we love economics and it can sometimes influence your trading. You can have a bias about, for me, sometimes it's Bitcoin or an index. And it's like, listen, you might have that fundamental bias, but the chart is telling us we're going in a different direction and we're going to trade the chart. So how do you adapt in that way in your swing trading, if that makes sense?
Yeah, I watch for the signals. I know there's going to be swings. The people get all mega bearish and I'm short everything, and the market already knows what's going on right now. That is one part of the efficient market theory where everything's known. People have already went to cash. They're scared. That's already happened. So we need to see what's happening next. And there will be swings. People will sell too quickly. The market will get overbought and it will bounce for a short-term swing to the upside. That's what I'm looking for, the swings to the upside. I also have some short systems when I use the VIX to trade the SPY. I actually use some VIX trending signals. The VIX has a 520 crossover, volatility's high. It could be a time, if it happens at a low enough RSI, that you could actually buy a SPY put and actually benefit from increased volatility.
That's interesting.
And you buy it at the money, about a 50 delta, and then the worst you can lose is the price of the put option,
right?
But you can make unlimited until it gets up to an overbought reading. So I do have some short systems, and not a lot. I'm not really aggressive. I do not like trading the short side. Like, people think they're going to be heroes. The volatility will blow their face off. They're all in short and bearish, and the Dow rises 1,000 points in their face, and then they cover. Right. Then it drops 1,000 the next day. I mean, the downtrends are not like uptrends. The volatilities can be multiples, and options will be priced in for the drop, so it's hard to make money. And then you can have the volatility collapse implied, the IV crush, and then your puts plunge when the market rallies.
Right.
So it's a very different animal. I'm much more happier trading some swings to the upside, even during the bear markets. There, some of the biggest rallies happen in bear markets. Some of the biggest swings happen in bear markets. So there's still oversold bounces and things you can do. So I'm still looking primarily long to buy those oversold bounces and swings to the upside, even in bear markets.
And you're probably at a good price, I would feel like, to be doing that, because, of course, it depends on the sector that you're looking at. And that was my next question. Are you looking more on the tech sector, commodity sector, or are you looking more to take advantage? I was talking to a guy yesterday who's been playing Boeing, Lockheed Martin, Rolls-Royce, Halliburton, anything that he can do with military industrial complex. He was playing that. Do you have a specific sector that you're like, okay, because of the war and inflation and this, I'm going here?
Yeah, I do. On my watch list, I do start adding in some commodity ETFs, some commodity-based stocks. What I really prefer, like Southern Copper, SCCO, FCX for copper, Alcoa for aluminum. Aluminum prices have doubled over the past. I think over the past maybe less than a year.
Yep.
So commodity-based stocks, but I prefer stocks even more because commodities can be so volatile. Especially, it's got too volatile to mess with. I still trade gold and silver, which have really been lagging because you can really see the demand is in actual commodities and food, not precious metals. That's been surprising. But I do trade gold and silver, and it doesn't really count on my I'll diversify. I'll try not to be overweighted in something.
Sure.
I won't have like all copper stocks. I'll have a couple copper, some aluminum, some precious metals if there's a 520 crossover. But the fundamentals can decide on my watch list, looking for themes. But I only trade based on technical price action.
Makes sense. I think if you look at lumber as well, that's an interesting commodity to take a look at. That's pulled back 50%, right? Natural gas I saw was down today. So it is interesting to see how the consumer side of the commodity sector is what's seeing the pump versus like you said, the gold and the silver, and lumber coming down now. I saw today, I think mortgage interest is at its lowest in like a year or two. So people looking to buy homes less, price of lumber coming down, maybe that can lead to some help in the housing market with more building happening. So I think like this is why economics is such a fun conversation, because it's so many little dots connected. You pull a string here and it pulls the string here. So with the overall picture, a lot of people are looking at, the US and China competing against each other. Do you ever feel like there's opportunity to go into a market, whether it's China or some other emerging market, and play their stocks, or is that considered too volatile for you specifically?
Yeah, I do have the India ETF, INDA. I do have a bunch of some of the emerging markets, EM, some of the other bigger baskets for diversified.
Sure.
I did remove the Chinese stocks off of my watch list, it's been about 7 or 8 months ago, because they got so volatile, and it's almost dangerous what the Chinese party can say in a day and destroy these ADR, most of our American depository receipts. So there's just too risk. It just doesn't fit my risk profile, the way they plunge.
That's what I was thinking.
I remove them for risk. That's the thing. People that buy and holders, the U.S. has been such a blessed place for so long with the growth and capitalism, and a lot of the buy and hold strategies only worked in the U.S. It's hard to find other countries that work that long. A lot of other economies got too much into economic growth killing policies, and they have not grown the same way. Japan has been
just going to say
is a one great example. A lot of the European countries are following that. The stock markets were just not built the same to go up like they do. You're mainly an income ETF in these other things. So India is my favorite to look at for everything, for people, the work ethic, the drives, the way they manage their economy. China,
I totally agree.
I took everything away from China just because of the risk involved.
Yep. I feel like we share the same opinion. Like, again, I think you get that Asian work ethic, you have so many people in India, so many smart people there, that country is setting itself up. And I feel like, James, you probably hear more about business with India than I do because I'm in the States, right? And you're in South Africa. So what's the perspective there?
That's what I was going to ask Steve. What do you think of the South African economy? I'm from South Africa, so that's why Austin's bringing it up.
Yeah, South Africa is a great country. It's amazing that so many traders exist over there, and their prop firms are over there, and they're really trying to emerge as with the West, really tie in with the West with the way our economies work and our capitalism. Yeah, that is one of the few other ones. I need to look at the South Africa ETF. I have not looked it up or back tested that.
There we go.
There is one.
Yeah.
Now we got some homework.
Yeah, for sure. Now, Steve, I just wanted to ask you a question. So, obviously when I got into trading with Austin, so I got into trading end of 2018 and finally found Austin, the man, and he put me onto you and, all the guys like Mark Bellafiore, all like the guys that are, like trading legends basically. And I always loved reading your New Trader the little write-ups that you do. You can email yourself the PDF on your website. And I was reading one the other day, and it was 8 tips for for traders that are not taught in schools, right? And the number 2 on the list was don't live your P&L. And you're talking about, especially during these times of like volatility, you can have like your best year ever. And then you actually say, if you just had your best year ever, I have some very bad news for you. You are at risk at having your worst year ever. And about like, what would your advice be for someone like me that's still young, in their 20s, and Austin that's in their 20s, that are starting to emerge in this trading career, but not trying to, as soon as your income increases, not trying to overspend? How did you manage that in your career yourself?
Yeah, you multiple streams of income make the P&L part a lot easier if you can find other ways to have cash flow so you don't have to tap into your trading equity. Easier said than done. I've always been very frugal. But from the point of actually trading a system, getting your system and process so quantified, it's like a business. You have it just like a business plan. You have what goes on your watch list, what the parameters are for things on your watch list, what your signals are, what your risk reward ratio is at entry, what your profit factor is, what you expect for the returns to be over 10, 20 trades, how many losses you can expect in a row during any 20 or 30 trades. I mean, have everything so quantified and so business-like that you can remove as much emotions as possible out of your trading, where you're just executing a business plan. You're like a casino. You want to be the casino mindset, having your edge, knowing you have a mathematical advantage over the long term. You don't want to be the gambler, emotionally driven and looking at every deal of the hand and every ante and losing money and making money, being emotionally moved by it all. You want to be the casino owner where at the end of the night you have an edge over the gamblers and you're going to make some money. And the losing streaks can be expected, but over the long term, your edge is going to play out. You have to have faith and confidence in yourself and in your process.
I love that. Great answer. What do you think, Steve, with the guys that are, what I said earlier about the newer guys that come to you? Because you've sent some people to us, which of course we really appreciate. And I think often when people are looking for trading education, you're a blog or a resource that people stumble upon. The issues that these new traders struggle with, I always find can be rooted in fear. And like you said, the lack of multiple streams of income can sometimes make you trade from a place of fear because you're just working with that account. Guys are going to, I've seen people leave their job and try to just go all in on trading very quickly. So if you could speak to someone who's maybe listening to this, thinking about trying to go all in on their trading, kind of to tie it to our illusion of full-time trading, what advice do you kind of guide the newer guys in? Do you tell them, have an account that's 6 months worth of savings, get another stream of income first? What's the first step if you give any advice in that direction?
Yeah, the very first step is having a proven model and system and have experience executing it and knowing how it worked out in real time, how you handled it, how you handle trading, the size, what your expectations are for returns over a few month period.
Sure.
Like you said, I have an article called The Realities of Trading for a Living, where, if you think the job stressful getting your paycheck, when you're losing money and you're not making money and you're working several hours a week, it can be much more stressful.
Right.
So like you said, I mean, I have, before I ever went full time, I had plenty of money saved up. I had low bills, almost no debt, had enough money to pay my house off at a very young age, and had very little stress to add to the stress of trading. You do not want to multiply your stress of trading with needing to pay the light bill. Another thing people have to understand, is most of the people that trade, the full-time traders, the professionals, the market wizards, they manage money. They're not trading to pay their light bill. They're managing millions, sometimes billions of dollars, and they're making what is it, the 5 and they make their cut of what they earn plus what they make on the capital, and they're making tons of money by trading other people's money. They're not trying to make a living off of a 5-figure trading account. That's and they need to also understand some of the greatest investors and traders of all time averaged about 20 to 30% a year. That's what the greatest. Not people, not a month, a year, and they had large amounts of money. I mean, there's market wizards like Minervini and different market wizards. Paul Tudor Jones, have done triple figure years, 100% returns, 50% returns. I've had 40 and 50% years that aren't audited, but I've had plenty. You can't really say you can't say stuff unless you have audited returns.
Sure. Yeah. But, I know what you mean.
But that's not normal. If you do 20, 30% a year, you're one of the greatest traders or investors in the world. All time, if you can do it 7, 8, 9 years in a row, and you can do it with some size. But people have got to understand, like you said, what is their expected return on their strategy, time multiplied by what their trading capital is, and can they live off that? And that math is hard to get to. Most full-time traders I know are millionaires or have minimum of multiple 6 figures of a trading account. Minimum.
And I think a lot of the guys now too, it's become more popular to get with other people's money, whether it's with a prop firm or with private capital or both. Some guys are doing both, like James, because using other people's money, I think, gives you, in some ways, a perspective of, hey, this is not me managing my own money. I'm managing money as a job. And then that can be seen as a different way. And then that also kind of separates you more from the, like James said before, the attaching to the results of your trading, where you're just saying, no, this is just one thing I do. I'm managing this money with this prop firm, but I also have real estate investments, or I also sell t-shirts online or whatever else, so you can kind of separate and then also look at it like, what's my other streams of potential income? So if a lot of what you said, Steve, is about quantifying the edge that you're going to go exploit in the market. So you're a big believer on back testing, I'm sure. We've talked about that before. And you mentioned TrendSpider already. They have that indicator named after you. And those guys are awesome. We gotta give Jake and Dan and all the guys there love, because they even helped me set up the TDI, the Traders Dynamic Index, on there. They didn't have it before. And they have a really great automated back testing tool. So do you spend a lot of time going through now and refining your strategy with back testing, or are you back testing new ideas still? What do you think you spend more time on?
I do both. Every time I add if it's inflationary environment, I go to look at all the commodity stocks and commodity ETFs to add to my watch list. I go back test every one of them. I start with a 520, 530. I go through all of it, look at the dynamics over time. I will even once or twice a year when I take an entry, I'll go back test something that I haven't traded in a year or two and see if the edge still happens. What people understand is sometimes your edge diminishes over time, and stocks quit moving the same way. Even indexes can quit moving the same way. New patterns can emerge. So I 100%. Do recheck over periods of time that all these systems still work, and because things do deteriorate, especially individual stocks.
So it's both. It's a little bit of both. You got to do both.
And also trade management. If you back tested, what you have. Like if you back test a 520 cross, on average it makes 10% or 7% return. Then when you get to about 7 or 10% gain on it, that you're towards the peak of what the possible maximum profit is.
Right.
And if it's overbought, it's probably a good time to go ahead and lock it in. You're not with another signal like an overbought RSI or what have you. Yeah, but other things, trade management. You can back test all you want, but you've got to manage the trade. You got to keep the loss small, and you got to maximize the win. That will make you profitable. Even Tom Basso did a study where random entries with trade management made money with no back testing. Just random. The trade management made the money, which is mind blowing when I read that article.
I know. I've talked to him about that. It's because it emphasizes to me how important risk mitigation is, and I was actually looking at a setup today. So we've been developing a new entry. We're going to call it the A2. It's a strategy using the 21 EMA and then a few other things to identify trend. And something we were looking at today for our stop loss placement, we're using a 1618 fib retracement tool. But I was showing one of the guys we work with, Tom, you've seen him, the Kaizen trader. And we were talking about using that fib versus using price action structure in certain situations, because the same entry signal gives you 3 different risk reward setups depending on where you put your stop loss and depending on how you manage that trade. Now, depending on where you put the stop loss, let's say you go with that highest potential point when selling it, that's going to mess up your potential risk reward if, let's say, it moves lower, but because you had that bigger stop, it doesn't go 1R. But if you would have had maybe a tighter stop that you could backtest and prove is still profitable, you could go with the tighter stop. Now that same trade moved 3R, you locked your stop loss at 1R, you don't lose any money rather than just barely getting your 1R and having it turn around against you. So like you said, same entry, but with risk management at the forefront of your focus and also trade management. That is, I think, the difference maker between the guys that are just amateurs and maybe not knowing how to manage properly versus the guys that are saying, let's go at this like Tom does with a risk first approach, Basso, where I could take a random entry. And if I just protect my downside risk and lock my gains, I could actually still be profitable. That's what that proves. Right.
Yeah, that's the edge. That is the edge. The management, the signal, the management. Yep. That's the edge where your profit's going to be big, your loss is going to be small. And big losses is what cause most traders to be unprofitable. Yep. Big 100%. Losses. What really hurts a bunch of buy and hold investors' feelings when they think they have the holy grail of buying and holding the SPY over a 20-year period. Right. They don't understand there's 50% drawdowns many times, right. And that's just what's happened in the past. We don't know. We could have another dead 1929 to 1952 market, but that the buy and hold, that's the holy grail, can be beaten easily with some moving average crossovers. I mean, even the end of month 200 day can crush the buy and hold. I mean, end of month 200 day moving average crushes
the buy and hold for sure, because you avoid the major drawdowns, right? Yep. Do you think it's possible to have single day market crashes like we've seen, like you just mentioned in those 2 dates previous? Is that with all the algos running the markets now? Do you think that could even be possible?
I think the market breakers they put in place have stopped that many times.
That's what I'm saying.
Seen that during that pandemic. That was like nothing I've seen even in 2008. I think those breakers is what stopped having another one. That's a good point. And I think that, like you said, back then it was like all these hedges, they were unhedging. All they were hedged up their eyeballs in 1987, and they pulled off all their hedges and caused the crash. And I do not think the market structure is that way again.
No, I would agree. You don't hear as many George Soros breaking the pound stories anymore, because they got the circuit breakers, like you said. That's a good point.
Steve, I just wanted to ask, so, with this, as you mentioned, the US economy has been so, with capitalism and everything like that, the buy and hold has just worked in your market so well. Do you think, so I always remember that on your New Trader U, your website, the avoiding big losses is the key to becoming a profitable trader, because that's one of the key things that stops traders from being profitable. Do you think that because people have been able to, traders have been able to buy and hold and, ultimately make money, do you think that has caused bad habits amongst day traders when they try and buy and hold, but as a day trade on a low time frame?
Yeah, absolutely. I can tell you, even from my experience during the .com, I mean, I thought I was a trading, investing god in the 1990s, because I was just like the holders of Bitcoin. I was like, all in tech stocks is tech. Early 90s, I thought that was the view. I was an investor holding tech stocks, and looked like I was just had that, like you said, upward bias. You have an upward bias, you're going to be bailed out because you kept making new highs over and over and over, and all the pullbacks and bear markets are so short, and you always got rewarded with a new all-time high until that stopped in March of 2000. Then we had another rush that was going to come back. That's where I learned that lesson. But I think day traders buy and they think, oh, if I hold, it'll come back. But in the day, because they have a loss aversion, it hurts their ego, it hurts their pride, it hurts them to take it, makes them feel unworthy, makes them feel bad. So they don't unlock the loss, and they get more joy out of holding it and get back to even and getting out than they do from simply letting a winner run. They're more stressed. A winner's running for a day trader, and they're stressed. Oh my God, I'm going to give it back. I got to take it. It's human nature is loss aversion. It's almost like we're built in reverse to cut losses short and let winners run. We hold losses when we get back to even, and we cut profit short when we give up the profit. It's amazing.
It's every so new trade. Crazy. It's so, and I think that is a big obstacle that traders have to get over as the hurdle. But this goes back to what we talked about at the beginning. It's a great question James asked, and it's a great answer. The context matters. Are you day trading? Are you swing trading? What are you actually doing? Are you mixing edge where you think because you caught a great day trading entry that it's now a swing trade? That's mixing. You could be mixing 2 strategies that together are a new strategy or a new form of an edge that you have no testing for. And I'm a big pusher to testing. When people say, could I do this? I say, sure. Could you back test it and let the data tell you what you should do and what you shouldn't do? Could you do something? Absolutely. You could do anything, but what should you do? Look at the testing. Should I, like today, Tom had an entry on oil. He was buying oil on that new A2 entry. And then another entry signal that we presented as it moved in his direction, it presented the second signal. And he said, should I add in here? And I said, I wouldn't yet, because our testing for this A2 so far is saying we're not adding yet. We're just taking the entry for 1R and locking the stop. So let's playbook this. That's a Bellafiore quote, right? Yep. Playbook this idea of adding in, save it. Let's get 100 of them, 50 of them, whatever. And then let's look at that and do testing and see, should we be adding in or no? And what other patterns can we find? So I think a lot of people miss that pattern recognition, miss that data collection step. They don't want to do that hard work, but it actually is fun. Because then, like you said at the beginning, Steve, when you get to that point of having confidence in your system, because you know what you know, like when I ask you, what are you doing right now? You're like, I'm not doing much different. I know what I know is my edge. Like, this is what works for me. Yep. So I think you can only get there through back testing. Like, you could watch somebody's course. You won't be as confident in the system unless you still back test it yourself, you know?
Yeah. A big thing that helped me too is how I make money, how to make money in stocks book. Went through all those historical charts, saw how everything played out. I mean, so many books. I just went through all the historical charts of the leading of indexes of what happened during different time periods, you know, experiencing 30 years of market moves. It's as bizarre the confidence you get where you're not in some mystery of what do you think is going to happen. You know what's possible. You know what normally happens. You know the patterns that typically happen. You know how hard it is that people that want to be Paul Tudor Jones and go all in short their whole account in a bear market and know the volatility is coming on them. And it's just seeing the confidence you get after just so much research and study and back testing and chart studies is and experience. You know, it does get much easier over time. You do become more mechanical and you're just running a business.
Exactly. And you made a couple of really good blog posts about current holdings from some of the hedge fund guys. You did Soros, yep. Paul Tudor Jones. I think you did Dalio. You did a couple. I had a question for you, and I want to know what your honest opinion is. Why does George Soros have so much Rivian?
Man, it's almost as if they want high. He knows that the gas prices are going to force people in electric cars, and it could be a big bull market, even if it's not based on fundamentals into Rivian and Tesla.
Did you notice that when you were writing it? Like, why has he got
the calls too? The calls.
That's what I'm saying. It was like 30%, something like that. A huge chunk of his portfolio, 25 something percent, all for Rivian going to the upside. I'm like, all right, he might know something that we don't know.
And he may very well be the greatest trader to ever live. He may very well be it because he broke the freaking Bank of England. He beat the Bank of England.
And doing what? Reading interest rates, knowing economics, and knowing what they were going to. He knew the government was squeezing itself into a corner before they even did. And once, just like people are saying right now, where Powell is just kind of kicking the can, at some point it tips over, just like it did for him, and it paid off for him because he was positioned right. And he's like the guys like, you know, Michael Burry, like they take these super extreme positions sometimes, and that one paid off for him. But then look at the other times where I think you've even highlighted where Michael Burry is wrong about calling a top in 2018 or 2019, you know what I mean? And he's wrong about it overall. So you got to take it with a grain of salt, you know?
That's the other thing. I mean, I did a lot of position trading, even on individual stocks with size, you know, in the early 2000s, some position trading. And I tell you, people don't understand, like you said, Michael Burry, you know, he held through so much heat on that the big short. He could have been easily bankrupted, not been a market
for
with it.
Sure.
Easily. Just the timing been a few months off. I mean, he's lucky he got out when he did. People don't understand that wasn't as easy as it looked in real time.
No.
How much heat you take on position trades, and it goes against you. He was right about Tesla, but going down. But the heat he took, he had to exit because it went up another, 30-40%?
Exactly. That was exactly what I was going to say.
Weren't people pulling their money from his fund when he was calling the big short?
Yeah, I'm sure people were.
Yeah, I think he locked them out during one period and got sued until they all become multimillionaires.
That's crazy. He's like, just shut up. I'm going to be right. You'll thank me.
I'm going to make you money. Yeah.
I can't. I mean, but again, those are such interesting people to study because the conviction is so amazing, but then the potential risk is also so amazing too, to the downside. It's just incredible. Look at like Kyle Bass. He's been calling the depegging from the Hong Kong dollar for years. And I know that at some point, if it hasn't already, his trade will expire. Like these ideas expire, which is why, like you said it already, Steve, the guys who are holding short, especially betting against America, they normally just get crushed because the downside of short positions is unlimited. It's not like a long position where you put a stop loss. If you don't use a stop loss on a short position, it can keep going up and wipe you out. So
look at GameStop.
Yeah, exactly. Exactly. So I think it's very, and again, I always go to Warren Buffett, who's you have to give him credit too, one of the greatest of all time, at least of our generation. He says, never bet against America. That's his thing. He does not like betting against America. And, call it whatever you want. And this is where super smart economics people are fun to listen to. I think the experiment, like you mentioned before again, Steve, how the US stock market just continued to pump itself higher from like 2008 all the way through till now. Other countries did not experience that. So this modern monetary theory that we've been living through, it just won't last forever. So what comes of it in the future? I don't know, but I am excited and I'm curious. This is one of my final questions for you, Steve. As things change, are you ever going to go, do you see, future Steve Burns 2030 writing a book, The Complete Price Action Guide to Crypto Trading? Like you going all into crypto because US equities become this weird market where we can't trade it. It's super volatile and not stable, but crypto is the thing. Could you see yourself doing that eventually?
I thought my wife is big into crypto.
I know.
But she's got her own metaverse company now. But,
yeah.
But I was, I was interested in crypto. I'd watched it for several months. I started back testing, and TrendSpider's got all the charts, and had the 5-10 crossover was working really well for crypto. And I took a small amount of capital and started trading it. And it was right before, by perfect timing, I called the top by starting to trade it because it got incinerated. And I shut off my system. It performed so badly, but it was a small. That was really my risk mitigation was a small amount of capital, amount of capital, just enough to maybe make me feel a little bit of it.
Right.
But that was So I'm like, man, I've proven I'm an equity trader, and I'm
for now, and I think that's what I'm saying. I think in the future, who knows what markets will be, who knows what it holds for us. But I think you're a really good example of someone who's always looking to take on new information. You would not have written as many books as you have. And I'm sure you've got more books planned in the future if you were not always consuming new information. So when you hear enough and we start hearing Steve Burns talk about crypto more and more, we're going to know, all right, it might be time to start. But, I've been trading a lot of Bitcoin. James has put me onto these prop firms that allow us to trade crypto, and it's been working really well for me. And I think, like you said, context matters. For me, short-term volatility like that, I actually do well in that because I'm not swing trading it. I'm not getting chopped. Like, look at Bitcoin's, you favorited my tweet. Look at Bitcoin's price action on Monday, down on Sunday night, and then all day Monday just inched its way all the way back up. Like, insane volatility.
Have you seen the correlation that's beginning with Bitcoin and the VIX, where
oh my God,
Bitcoin's almost like a risk when VIX tops out, if Bitcoin bottoms out, they usually reverse in correlation. It's fascinating that
I wonder why.
It's almost like it's a risk on asset now. It used to be a hedge against inflation, and now it's like a speculative high growth digital asset.
Do you think that it's tied so similarly to the indices recently, especially NASDAQ too, because companies in NASDAQ are holding Bitcoin on their balance sheet? Do you think that that's part of the reason?
That's a good point. I don't think there's enough exposure. I don't think there's enough.
That's what I thought. I didn't think it would be enough.
But it's almost like risk appetite. It's almost like it's become, to what I've seen, it's become more correlated with risk appetite. But my wife has dealt more in sand. She had an NFT drop and got paid in sand, and with the sandbox game, and Ethereum is the two things. I love Ethereum is my favorite.
Really,
I don't trade it currently, but Ethereum is my favorite.
But it has a lot of use. Ethereum.
It's a user case. I mean, the gas fees sometimes melt your eyebrows, but the user case is great. But I think the mistake I made on the crypto, I did on the backtest 510 crossover did great. One of the best trending things I've ever seen on any backtest in my career. But the volatility is also some of the highest volatility I've ever seen. And when it goes down, it's the percentage moves are mind blowing.
Right.
But people that got in early did a 510 crossover should all be rich now.
The whole crypto thing is super interesting. We're at this, I think we're at not that we always are not at an interesting point, but it's almost like an inflection point because, I mean, we've cut half of Bitcoin's value off. If Bitcoin struggles to get back above, its previous all-time high, I think over time, the longer it takes to get back up there, the more people will lose faith in it. I just have that feeling, especially with everything going on right now with people, with the whatever shortage you want to talk about, or the inflation and everything getting more expensive. Like you mentioned, like all these things, people are looking for reasons to almost be cynical and be frugal. And if Bitcoin can't get back, let's say we see Bitcoin at 10 or 15K, people are going to be like, oh, it's a scam. Oh, it's, you know what I mean? And I think that'll hurt it more. So I'm just super interested to see how it plays out from here.
It's dangerous. It's never see how it evolves. Like if it ends up being the bullion of the crypto world, where it's not really used to buy coffee, it's the bullion, and then Ethereum could be the U.S. dollar used to actually buy NFTs and on the blockchain. It's gonna be fascinating to see how it might be technology play in which crypto has an edge. What's the best user case for what crypto? Because that's the reason the U.S. dollar owns the world, and even the reserve currency. It even could depeg from gold, because you can come to the U.S. with dollars and buy anything you ever dreamed of. And I think that's the value of the U.S. dollar, and why it keeps its buying power. Well, it's come down inflation power, but versus other fiat currencies.
Sure.
But, and the other thing, the U.S. military backs the U.S. dollar too. Exactly. So I think the U.S. dollar is a user case for what you can come to the country and buy with it, how you can trade with it, how you can buy oil with it, and the military backing of the U.S. I mean, so which crypto would reflect that will be interesting to see.
And in the midterm, people want to speculate. It's going to be Ripple. It's going to be Ethereum. It's going to be Bitcoin. You know what I'm going to do? And I'm sure you're doing the same thing. I got out of my XRP. I figured out how to get it out of Coinbase like a year and a half, 2 years ago, when the whole lawsuit thing started with the SEC. People are stuck. Like we said, the 2020 and 2019 bull run created a lot of stubborn bulls that are refusing to say when charts have turned down and say it's time to stop. And again, it also creates the bias of buying every dip, like you said, because the dips were so short-lived. But now you could have bear markets. If you study 2007, 8, 9, we were in a bear market, but we had 30% bounces to the upside and we still went lower. So I think people are in for a rude awakening. Those people, especially that, like we talked about, the guys that just got into the market over the last couple of years,
Yeah, I knew that the Bitcoin holders were in for a rude awakening, and the Cathie Wood acolytes. Like I've seen this play out. I mean, I saw this stuff playing out in the early 2000s and 2008. I mean, this is nothing new. There's no tree grows to the sky, and everything comes back to earth. And most things retrace 50% eventually, even the S&P 500.
Yep.
So like you said, this is not something new.
No,
I think it's going to go up forever, and there was endless buying power, and everyone's going to hold forever. It's crazy.
No, and if you're optimistic, like PayPal down 50%, companies like that I think are great companies down, even Apple where it's at right now, companies that they're in a way, if you have a long-term perspective and you're optimistic, it's a discount. Tesla's, they're discounts if you're really long-term, if you're dollar cost averaging, you want to get out of that day trader mindset. I know this is the day trading show, but now we're in the investing show. We're transitioning now. No, but if you get out of that mindset, you go back to context, like you said, this could be a great buying opportunity if you think America is still going to be a superpower, if you think we're still going to be the top dog, or at least one of the top dogs, which we probably will be. I would hate to be that pessimistic. That would be a negative life to live, right?
Yeah. And it's just not mentally not good in the rest of your life. My son wanted to start his 401k up at his, I think he works for Amazon, and he wanted to start, and he loves Tesla, obsessed with Tesla. And I said, well, let it crash 50% first. That's going to, and I said this to him, about a year and a half ago. It's going to happen. That's how it all happens. Let it crash 50% first. And then, like you said, dollar cost average into it. And that's that's what you want for your investment account. And, that's got to blow his mind, because he thought it was going to go to 2,000 or 3,000. And no, that's not how any of this works.
It probably will.
Yeah, but not 50% comes first.
No, right. It doesn't go straight there. Exactly. All right. Listen, Steve, this has been amazing, man. It's always good to catch up with you. I'm sure people are going to be enjoying this episode. Right now, the book is out, The Complete Guide to Price Action Trading. What's next? Another book coming in the mix? Anything exciting new coming?
Yeah, I'm pondering the outline for the Swing Trading 101 e-course. I haven't made an e-course in a very long time. I'm almost ready to do that. And also Moving Average crossover book. Nice. To follow up on the Moving Average 101 book that's been so interesting for everybody. So a lot of back-tested data, and go deep in the numbers on that one.
Love that. All right. So for everybody watching, listening, whether you're on Spotify, on YouTube, wherever you're at, I'm going to make sure you've got links to Steve's Amazon store, to his Twitter, to his Instagram. Oh, congrats on over a quarter of what are you at? 250, 270K on Instagram. It's crazy, Steve.
Yeah.
Killing it.
Yeah, and not doing it how I'm not supposed to, doing pictures of tweets and memes, and not bikinis or anything.
It's like, if you look at I know you see, I've taken after you because it works. It's interesting. Those pictures of tweets get me more reach, like more random people that have never seen me, versus my reels. Those are my followers. So I've learned from you how to communicate, reach the randoms, and then hit the followers with the content, so it's been a great model to follow.
My black and white checkerboard came from you, because you did your blackout tweets. You're the one. That's where my black tweets came from you doing that. Like,
I'll take it.
I'll take
it. I'll take it. All right, brother. It's good to see you as always, Steve. James, appreciate you.
Yeah, thanks so much, Steve.
Yeah, absolutely.
Thanks for talking to you guys.
Always. All right, everybody. See you in the next one. Thanks, everybody.
See you.